All right, well, hello everyone, and again, welcome and thank you again for joining us for this webinar where we'll be discussing in more depth the 2020 Distressed Communities Index. My name is Catherine Lyons. I am the Manager of Policy and Coalitions here at EIG. I'm really pleased to be joined by my colleagues, Kenan Fikri, our Research Director, John Lettieri, our President and CEO, and August Benzow, our Research Analyst, who all put in a great deal of effort into this latest report. Before we get into the analysis and results of the 2020 DCI, we're really thrilled to be joined by Senator Tim Scott, who recorded a message to kick off this discussion and introduce the DCI and its importance, particularly in developing and helping develop policy solutions for a more equitable and inclusive economy. So I will start that video now, and then we'll get started with the discussion.
Hello everyone, it's Tim Scott here. I want to welcome you to the EIG's webinar on the Distressed Communities Index. Since 2015, the Distressed Communities Index has helped shine a light on the areas driving inequality from educational achievement to home ownership. This data helped us create the Opportunity Zones Initiative, a once-in-a-generation chance to change the future in neighborhoods across the country, and will continue providing critical analysis of what's happening on the ground in the communities that need the help the most. The pandemic has further exposed and intensified the needs of our underserved communities, making this report even more necessary and helpful. Opportunity zones were designed in part because of the uneven recovery after 2008. And frankly, opportunity zones were designed because as a kid growing up in poverty, I knew firsthand that my friends had lots of unlimited potential, but the opportunities were too far away. And they will help to ensure a holistic recovery in the midst and then after this pandemic in a similar fashion that we've seen every generation rise to the challenge and overcome the obstacles. With more than $75 billion committed to new investment in distressed American communities, estimates show opportunity zones could lift at least 1 million Americans out of poverty, and that would be a decrease of 11% decrease in poverty within the opportunity zones. Great news. That is great news. If you're here today, that means you care about these issues too. You're showing your heart. You're showing you want to help kids growing up like I did become better. You're restoring hope. You're creating opportunities. Keep that faith. Keep that drive to help those in need. We are creating an opportunity society, and we're going to need all hands on deck. Thank you again to EIG for putting this report together, and to all of you for being here. God bless. Have a great day.
Great. Well, again, we're so grateful for Senator Scott for introducing this discussion. Before I turn it over to John, I wanted to note that we are recording this webinar, and we will be posting this webinar on our website within about a week or so, if not less. So anyone who has registered for this event will receive shortly a recording of this, and feel free to share that and re-listen at your leisure. Additionally, we will have time for Q&A at the end of our presentations. If you have any questions throughout the presentations, please use the Q&A box. It's just a little bit easier for us to navigate and make sure we don't miss any of your important questions. So please use the Q&A function to input any questions you may have, and we will get to those at the end of the presentation. So now I will turn it over to John Lettieri, EIG's President and CEO, to kick us off.
Thanks, Catherine, and good afternoon, everybody. It's great to be with you to talk about our new report. So I'm going to give some brief framing remarks before we dive into the findings and features of this project. At EIG, we consider the Distressed Communities Index to be our flagship research effort. And I believe this year's report is one of the most important and timely that we've released in our 5 years as an organization. First, I want to explain why we do this. when the health of the US economy is considered only in aggregate terms, we miss out on the textured and deeply uneven story of how national growth and prosperity either lift up or leave behind individual communities and the residents who call them home. The DCI is therefore our attempt to understand the spatial distribution of US economic well-being. It's a lens through which we can evaluate where and for whom the country truly lives up to its promise as a land of opportunity. And we intend for this to be a practical tool, not simply an analytical one. As you heard from Senator Scott, the DCI has been used by policymakers from across the political spectrum to inform various legislative initiatives over the years. It's been used extensively by journalists to tell stories about national trends and local case studies. It's been used by nonprofits and local governments to allocate resources, by academics and researchers, and by private businesses and organizations. This edition of the DCI comes at a time of national introspection and quite a bit of upheaval. The COVID-19 pandemic has once again exposed deep fractures in our nation's social and economic well-being, disproportionately affecting the most disadvantaged Americans and their communities. The events of this year provided a sobering reminder that the terms of the American experience are still too often dictated by race, place, and inequality. And those are the themes that form the heart of the analysis that we're going to talk to you about today. This report covers a period going back to 2000 to examine the arc of community well-being so far in the young century. And what we find is fundamentally a troubling story, but one with signs of hope. The troubling piece is that in spite of decades of economic growth, in spite of significant economic expansion after the Great Recession, the country's national growth has fundamentally failed to raise the floor of well-being for our country's most vulnerable people and communities. The hopeful piece of this is that we have made progress. We have made progress in providing a more inclusive look at prosperity at the top. So for the most prosperous communities, we find in this analysis that they seem to be more open, more diverse, and more inclusive of a wider array of Americans, but there's still a lot of work to do. So ultimately, we hope this research will serve the goal of forging a more inclusive and successful recovery for all Americans in the wake of the COVID-19 crisis. And as we look ahead to a new Congress and a presidential election, we hope that policymakers will take note of this aspect of evaluating the health of the American economy, that we have to look beneath the national numbers and we have to look to communities and understand how Americans are or are not participating in the national story. And with that, I'll hand it over to my colleague, Kenan Fikri.
Thank you, John. Let me tee up the presentation here by sharing my screen. Let's see. Okay. And okay. Catherine and others, can you see the full screen presentation?
Yes, just put it onto slide view or slide.
There it is. Yeah. Wait, there we go. Okay. That good?
Actually, not on presenting view. Sorry. Do
Use slideshow.
yeah, we can see kind of all of the.
Oh, you can see the whole background.
Exactly.
Yeah. Yeah. How about now?
Perfect.
Okay, now I can see myself as well. Thanks, everyone. Yeah, we are analysts and geographers, not tech folks. All right. Okay, so thanks so much for the introduction, John and Senator Scott, as well as Catherine. So we're really pleased to be sharing with you the insights from our own analysis of the DCI. And I'll tell you a little bit about how the index is constructed before walking you through the findings with my colleague August Benzow and co-author on this project. And we break up the findings into kind of three different buckets and angles. So one is around geography, one's around race, and then one's around economy. And I think there's a bunch of interesting insights embedded within each of those. So what is the Distressed Communities Index? So here it's we calculate a measure of economic well-being that's combined of 7 kind of complementary and distinct metrics, and it's worth pausing on why an index-based approach to evaluating community well-being is important. And we think it's fundamentally critical because each indicator in isolation only presents part of a picture, right? A high poverty neighborhood that is still doesn't really have high numbers of housing vacancies, is maybe a working class immigrant neighborhood, has a fundamental vitality and kind of potential economic opportunity to it that the deeply, chronically distressed sort of neighborhoods that score poorly on all sorts of different metrics just don't. And then likewise at the top of the spectrum, communities, say in the Northeast that, have the highest incomes, the highest educational attainment rates in the country, but in that kind of established corner of the United States don't really post super high growth rates that can compete with suburban Las Vegas. They get missed out when you only look at growth-based metrics of economic distress or prosperity. So we are big proponents of taking distinct elements of well-being, packaging them together, weighting each one equally, and then combining them into an index. And we we utilize the DCI methodology in this report to analyze zip codes. But if you look at our interactive map online, you can see that we've mapped it all by counties as well. We will soon be releasing next week a report that looks at cities and places across the US and ranks them against each other. And you can also do it by congressional districts. And each one, we'll get to the method now. Each one, I think, provides a different look at how economic well-being and economic inequality plays out across the U.S. So there's kind of an interesting insight at each resolution of analysis. So we rank all zip codes on the 7 different metrics and then average their ranks before we translate that into a percentile and then group zip codes or counties, whichever unit we're looking at, into 5 even buckets of well-being, ranging from prosperous at the top through comfortable, mid-tier, at-risk, and distressed. So each one of these groups contains 1/5 of all US zip codes each. And the core of the report is off of 2014 to 2018 data, but we also here take a look back and want to use this moment of national introspection and hopefully reset, as John mentioned, as a point to look at the long arc of growth and see how over the course of this young century, the map of economic well-being in the US has changed or not. This is what the zip codes look like as you map them, and we'll look at the interactive more later. But one of the most striking findings from the DCI is that even though it's a relative measure of economic well-being, so even though just axiomatically 1/5 of all US zip codes will always be considered prosperous and 1/5 are going to be considered distressed, the gaps that this reveals are really profound. If you look at things like basic educational attainment or poverty rates, usually distressed zip codes perform 4 or 5 times worse than prosperous zip codes on average. Or housing vacancy rates, another one. But what is most damning to us about the current trajectory and nature of US economic growth is that it's failing to reach and lift the places that need it the most. So if you look at the bottom right-hand corner of the chart, you can see that in the country's distressed zip codes from 2014 to 2018, the average one actually continued to lose jobs and continued to lose business establishments, even through those core years of what was the longest economic expansion in modern American history. So growth, the nature and geography of growth seems to be perpetuating our divides rather than closing them. And what was interesting with our look back to 2000 and surprising to us is that these averages, if you take the average score of a zip code landing in each quintile between the 2 periods, so the 2018 period of the 2001, nothing was preordained to say that the benchmarks really wouldn't look that different between the 2 periods, given that it's a relative measure. But at the end of the day, we saw very little progress in what defines communities at each tier of economic well-being. So educational attainment, this just looks at 4 components of the DCI and the average zip code within each quintile. Educational attainment progressed nationally. It progressed in each tier of community as generations clock by. The baseline level of educational attainment in the United States is rising. But other than that, the poverty rate designations or distinctions were about the same. The same share of adults were not working in prime age adults were not working in distressed communities in 2000 and in on the 2020 DCI, and even kind of how the housing vacancy rates, especially in distressed zip codes, were significantly higher. And none of this was preordained. So this gets to what John was talking about there in the intro, that we really haven't raised the floor of what it means to be a distressed community in the United States over 2 decades of growth and change. Better news, however, is that the US population has significantly shifted towards higher levels of economic well-being. So if you go back to 2000, about equal shares of the country's population were distributed in the bottom 3 quintiles, about 50 million apiece. There in mid-tier, at-risk, and distressed. But by 2020, a pretty steep gradient had opened up, which shows that economic well-being is becoming increasingly associated with the places that more Americans live and congregate, so specifically metropolitan areas. It's been a pretty good decade for density and for the country's real metropolitan engines. And we see that they are lifting up, as their well-being improves, they're lifting up large chunks of the US population, as well as they're the places that people are voting with their feet and moving to. Those who have choice generally choose to live in communities with higher levels of economic well-being. So the total number of Americans living in distressed zip codes has been pretty flat over the 2 decades so far. So where are people living in those top 1/5 of American zip codes centered? They are parts of the Mountain West, the Pacific Northwest, and Northeast and Great Plains. So across much of the country, really, you get extremely high shares of the population living in these top tier zip codes. In New Hampshire, which leads, it's almost half the population. Similarly in Colorado, and then Minnesota ranks 3rd. And then at the other end of the spectrum, distressed communities and the people residing in them, they're concentrated very much in the South and the so-called Eastern Heartland and parts of Appalachia, and as well as kind of tucking into the Southwest, where often you have large distressed Native American populations in states such as New Mexico and Arizona. So digging a little deeper into the geography of well-being and how it's shifted over the past almost 20 years. So urban zip codes have seen really significant advances in well-being since the turn of the century. And this is the product of 2 different forces. So one, many urban areas have improved, especially in really large cities. So if you think of New York, Washington, Los Angeles, coming out of the 1980s and 1990s, they were not economically thriving locales, but they've really seen a substantial rebound that's been well documented, in national press and conversations over the several years since. So that contributed to increasing the share of Americans living in well-off urban areas. And then almost the more powerful factor, though, is the expansion of urban America across the West. The Western development occurs at much higher density than it does in the East, and through that and through the just population growth of metro areas such as Denver, such as the Wasatch Front in Utah, and smaller cities throughout the Pacific Northwest through Montana and Idaho, you've seen just large increases in the number of Americans living in prosperous urban communities. So at the end of the day, the total number of Americans living in a prosperous urban zip code has doubled over the course of the study. And you can see here that the share of urban Americans living in distressed communities has shrunk pretty significantly from over 1/3 to just over 1/5. Moving on, looking at particular cities. So here are extracts from the interactive maps that you can explore online. A city like Portland, Oregon, it did not have really any prosperous zip codes in 2000. And come 2018, the metro area was replete with them. And then Washington, D.C., it actually didn't see a huge increase in its most prosperous zip codes, but it saw really dramatic decreases in the distressed zip codes and offsetting increases in the comfortable and mid-tier quintiles as the number of distressed zip codes in this city fell from close to 10 fell from 8 to 2 over the course of the period. So now there are just 2 remaining distressed zip codes southeast of the river. And then all that being said, there are large tracts of urban America that have not enjoyed the boom that has lifted much of the West or some of the country's bigger and more established urban hubs. If you take Indianapolis, Indiana, it on some respects is one of the Midwest, Midwest bright spots, and it's a city that's one of the most strongly growing in the region. But at the same time, its number of distressed zip codes increased significantly over the period, and emblematic of many cities of its size in its neck of the woods that you may be seeing downtown resurgence and have thriving kind of suburbs and exurbs, but they're also seeing the slow and steady creep of economic distress outside of central cities towards inner suburbs, aging suburbs, and areas with high minority populations. And then Chicago, to some extent, it has seen rebounds in many zip codes to the north and the northwest of the city, but it continues to have the largest kind of continuous band of distressed urbanity in the country, ranging, it's going over 60 miles from northwest of downtown there, all the way through the industrial suburbs of northwestern Indiana. And there, its population in distressed zip codes fell because its distressed zip codes are depopulating, not because its distressed zip codes are improving. Meanwhile, rural zip codes were on the kind of reverse side of the urban rise that we've documented, where the population in rural distressed zip codes increased by 12.7% over the period, such that now, a slight plurality of rural Americans live in economically distressed zip codes. And so it's getting increasingly difficult to generate kind of nation-beating levels of economic well-being in urban areas in the modern economy. In rural areas in the modern economy. And then especially in the South, rural areas are most likely to be distressed. In parts of the Midwest and in parts of New England, they maintain pretty high levels of economic well-being, but distress and rurality are really most synonymous today in the South and the Southeast. And through it all, the American suburbs have maintained their grip on prosperity. Over 60% of the population in the prosperous quintile of zip codes lives in suburban areas. Any random suburban zip code in the United States is far more likely to be considered prosperous than fall into any other tier of economic well-being nationally. And if you explore on the map, really any metropolitan area, but it's especially stark in areas like Minneapolis, St. Paul, where you have just a vast kind of sea of suburban prosperity surrounding central cities. There, it's over 130 different distinct zip codes, home to 2.2 million people. All concentrate those nation-beating levels of economic well-being around a major metropolitan hub. And then the Eastern Seaboard, of course, probably maintains the most significant stretch of continuous prosperity in the country, arcing, from the really Portland, Maine, all through the Boston suburbs, down the corridor to north or to west of the DC metropolitan area. You can see the suburbs are really kind of the catchment areas and where the wealth and money generated by the country's major hubs kind of goes home and goes to rest. Last point on geography, just reinforces the increasing westward shift of prosperity. Back in 2000, the Midwest actually led the nation in economic well-being, with the highest share of its residents living in the top 2 quintiles on the DCI. And since then, it's fallen to third from the bottom, just leading the South, but behind the Northeast. And that's its toggle positions with the West, which has, if you look back at the kind of the arc of how the map of the United States has changed since 2000, really the rise of the West and these dynamic, fast-growing metro areas is one of the most significant stories. And it's one that we see playing out politically too, as I think the politics of the West change and more states in that region turn purple and are almost the new battleground forging the American political consensus. So with that, I will turn it over to August. Thank you.
Thank you, Kenan. In this next section, we will be looking at the report's findings around race, economic distress, and community prosperity. The key takeaway here is that even though significant progress has been made since 2000, economic well-being for Americans is still sharply divided by race and ethnicity. Next slide. As you can see in this chart, 35% of Black Americans live in a distressed community compared to 11% of whites. For Native Americans, it's even higher at 37%. A majority of white Americans live in a process of comfortable community, which isn't true for any other race or ethnicity except Asian Americans. Putting it all together, over 1/3 of Blacks and Native Americans live in a distressed community. Next slide. Another way to look at this data is by the race and ethnicity composition of each quintile. This clearly shows you that minorities are disproportionately overrepresented in distressed communities. They make up around half, actually a little more than half, 56% of the population of distressed communities, even though they represent 39% of the national population. By contrast, processed communities are 73% white. Next slide. One big positive trend is that since 2000, the nation's more prosperous communities have gradually become more diverse. The non-white population share of processed zip codes jumped from 16% to 27%, slightly surpassing the growth of the non-white population nationally. And you can also see in this chart that the minority share of on the distress band decreased from 59% to 56.4%. Not a huge decrease, but significant nonetheless. But there's still a long ways to go. There would have to be 10 million more minority residents in prosperous communities for their share of that quintile's population to match their share of the national population. Next slide. Following a similar pattern, the country's immigrant population has become less likely to live in a distressed community over time. Processed communities now contain more foreign-born residents than any other quintile, 10 million in total, or about 23% of the country's 43 million immigrants. And on the bottom tier, you can see that the distress share has plummeted as well, which kind of points to the upward mobility of immigrants in this country as they move into the upper bands of the DCI quintiles. Next chart. Nonetheless, racial gaps basically persist in every tier of economic well-being, most notably for Black Americans, but also for Hispanic Americans as well. As you can see in this chart, the median household income for the typical Black household in processed zip codes was 92% that of the typical white households. In distressed zip codes, it's only 60%, which, considering that this is the bottom quintile, that's really speaks to the economic disadvantage for Black Americans who are living in distressed communities, just how big that gap is. Next slide. We not only see these gaps in household income, but also in home ownership, which is indisputably a critical pathway for wealth building. Not only does it allow families to bolster their financial security, but it's also an important source of wealth that can foster entrepreneurship and upward mobility. So I think what's most striking here is that white households in distressed zip codes are actually more likely to own their homes than Black or Hispanic households in processed ones. And this is definitely going to be a very topical issue since one of the big fallouts we're seeing right now from the COVID-19 pandemic is higher eviction rates, but also pretty robust housing market. So I think homeowners are in a much stronger position right now than renters. Next slide. If you look at just majority Black zip codes, an overwhelming 70% of these zip codes are distressed, compared to 20% nationally, and 16% of majority white zip codes. And this unequal distribution has really seen little improvement since 2000. In 2018, 1.8% of majority Black communities were prosperous compared to 1% in 2000. And nationwide, there are only 19 prosperous majority Black zip codes, and 11 of those are actually located just in the DC metro. Next slide. In the Midwest, this number of majority Black distressed zip codes is even higher. 82% of the region's majority Black communities are distressed. And more than half of Black Americans who are living in the Midwest are in a distressed zip code, compared to 35% in the South and just 13.2% in the West. So once again, this kind of really puts the Midwest in the foreground as kind of showcasing the worst effects of the country's underlying inequality. Next slide. So this next section looks at how economic disparities drawn along the lines of geography and race can become even further stratified by educational attainment and occupation. Next slide. So this chart shows is around half of adults living in process communities work in management and professional occupations, nearly double the share in distressed communities. And inversely, the share of adults working in service occupations, occupations which have suffered the most from the pandemic and its corresponding economic fallout, is about 10 percentage points higher in distressed communities than in process ones. So this is another way in which distressed communities are going into the current crisis at a disadvantage. Next slide. Process zip codes, as you can see here, capture the majority of job growth, while distressed zip codes actually record a net job loss from 2014 to 2018. Excuse me, from 2000 to 2018. In that time period, process zip codes gained 8.7 million jobs, which is actually more than all the other quintiles combined. Over the same nearly 2-decade time period, 2000's distressed zip codes, really did not see much net employment growth at all as a group. And you can see kind of like at the bottom that both at-risk and mid-tier also did not really see very robust job growth in that time period. Next slide. So this chart kind of zooms into the tail end of the recovery and basically focuses on the time period from 2014 to 2018. And we see here that distressed communities have continued to struggle, even though we've been seeing record national growth beginning in 2010. And they've actually process communities actually added more net new businesses than the other 4 quintiles combined between 2014 and 2018. And meanwhile, distressed communities lost business establishments from 2014 to 2018. Kind of putting some numbers to this, these distressed zip codes have lost 17,000 businesses altogether since 2014. And this is on top of having lost nearly the same amount from 2010 to 2014. So if you combine those 2 time periods together, these distressed communities have lost 33,000 businesses from 2010 to 2018. Next slide. Process zip codes have a significant advantage in terms of being hubs for the highly educated, and this educational attainment gap has significantly increased between 2000 and the current DCI. Process zip codes now contain about 40% of the country's college educated population, compared to 26% of total population. And nearly half of all adults in process zip codes have obtained at least a college degree, up from 38% in 2000. By contrast, 56% of adults in distressed zip codes are striving to find opportunity in the modern economy with only a high school diploma or less. With that, I'm going to pass it back to Kenan to provide some key takeaways.
Cool. Thank you very much, August. So just to wrap us up and take a step back, because I know we flung a lot of data at you. So what does it all mean? And here's some of the things that speak most to us. So one, we captured here in this time period 2 recessions and 2 expansions, and those past 2 cycles of growth have done little to raise the floor in economic well-being nationally on their own. So even if some of the zip codes change, on the bottom quintile over time, and about 2/3 stayed the same, so 1/3 of them changed. Again, the absolute indicators of economic distress in the country are not improving, and I think that challenges a lot of the kind of notions of fairness and expectations that many of us have from the economy. That we should be on a track of progress. And this shows kind of stagnation for the people who need progress the most. So I think that if anything should inform a new economic model coming out of the pandemic recession, perhaps it's this stat that we need a policy agenda that tries to foster convergence across the map, not by reining in the leaders, but by trying to give a boost to some of the laggards in places where well-being really lags behind in the term. Then second, it's definitely it's undeniable that the tail end of the expansion that has just come to a close in the high pressure labor market and economy that we were experiencing finally started delivering benefits to the most disadvantaged people and places in the economy, or those that were kind of bypassed or left behind or on the sidelines of most of the economic expansion of the 2010s. But I think the DCI helps us take a step back and really take a harder look at the economy that went into the pandemic to see that when you see the best performing American communities pulling away from everyone else to such an extent, it's clear that the gaps are actually, the gaps got wider for not just 8 years that we document here, 2010 through 2018, but even going back to 2000. Over those periods, the terms of engagement in the economy are just improving for those who were already well off, deteriorating for those who weren't, and 2 years of modest growth for people who have not experienced it for going on the best of 2 decades, if not longer, isn't enough to close the gaps. So I think our point here is really that yes, there's a lesson that a full employment economy is good for low-income people and low-income communities, but it will likely require a little more intentionality to again boost the most disadvantaged people and places among us to accelerate a more inclusive recovery coming out of the pandemic. And nonetheless, the findings presented here suggest that real progress is achievable in reasonable timelines towards both inclusion and renewal. We've seen vast swaths of urban America turn around significantly, true to their assets, true to their longstanding residents, and just kind of coming into their own again after a period of decline. So that I think taps into the spirit of resilience that's appealing to a lot of people right now and is innate to the American experience. And we've also seen that progress towards inclusion has been meaningful. It's been slower than we would like. The starting points are farther behind than is fair or conscionable. But at the end of the day, over the 18-year period that we look, we saw vast improvements in the exposure of communities of color, in particular, to improved economic conditions in their communities. So there's definitely still, the DCI itself is a neighborhood level look. It doesn't look at individuals. There are important questions about inclusion and whether local growth in rebounding urban zip codes is is directly benefiting and how it's directly benefiting some longstanding poor residents that the DCI speaks to a little bit, but not as much as an individual focused analysis would. That being said, we know how important neighborhood conditions are to economic opportunity and economic well-being, and just the fact that their exposure to better conditions has increased substantially is a significant achievement, and one that we should build upon in the next phase. Then diverging rates of educational attainment are, I think, they're one of the things that we absolutely must grapple with in order to start to bend some of these curves and foster some of that convergence that I was talking about. Educational attainment, if you know that of an individual or a zip code, then you can pretty much figure out where it lands on any other metric of economic well-being that you're interested in. And the fact that the educational attainment gaps between zip codes continues to widen is a problem, and I don't think that we can expect much catch up or growth in distressed areas if we don't improve the state of educational attainment and workforce development policy in those places. And then lastly, it's as we keep living through and better understanding with each day the local and human impacts of the pandemic and pandemic recession, the DCI reminds us that entire communities here are vulnerable because, given how Americans sort along lines of race and class and occupation and income level, a lot of the workers in the frontline industries most affected by the pandemic recession, so that the services sectors are concentrated in particular communities themselves. Those communities were generally struggling to support businesses and maintain occupancy rates and et cetera before the pandemic, and now as their neighbors end up suffering disproportionately from the negative economic effects, even setting aside the health effects, the situation in these communities could really deteriorate significantly before it gets better, and that's something that we need to ward off. So with that, I will, while we gather some questions, I'll put a plug in for the interactive that we have online. It's eig.org/DCI, and then you can just click on the interactive maps tab. We here, we're really proud of this interface and just encourage you to go and choose your own adventure and get lost in it. But you can explore the DCI data by state, by zip code, by county, by congressional district. And I think one of the most appealing aspects is that when you're at the state level look, say, you can choose to look, you choose, say, the demographic information. So looking at the state of Ohio, you can select the Hispanic population and see how they're distributed across the 5 tiers of well-being in the state of Ohio. Or you can look at services industry workers and see how they're distributed. Similarly, the native or the foreign-born, and a couple other demographic angles, including by educational attainment. So I think it gives you a really rich understanding of not just what the map looks like, but who the people are in these communities and how they're sorted across places. So I will hush up there and give us time for questions. Thanks.
Great. Thanks so much, Ken and August, for a great presentation. We are getting quite a few questions as well as compliments on the interactive graph and features. So thank you very much for those of you who found it really useful. We're really glad to hear that and really appreciate the positive feedback there. So I'll start with just a couple of more methodological questions, and then jump into some of the more substantive questions as well. So first is median household incomes in the metrics modified by local cost of living?
Yeah, August, I'll let you take the methodological ones first.
Yeah, sure. So yes, the answer is yes. Median household income enters into the index as a share of the area of median household income, metro if it's in a metro, state if it's outside of a metro. So it's kind of actually a new tweak for this current iteration of the DCI to kind of like tailor that income to factor in for places that maybe people have a higher household income, but the cost of living is much higher.
Great. And one more question. How have you accounted for people that identify as 2 or more races?
So it's not really a group that we go into much detail. We did include those numbers in our analysis initially, but generally in most zip codes, that's not a very large share of the population, so it's rather difficult to kind of do a deep dive into that group. Most of the high share of of people identifying as 2 or more races tend to be in places like Hawaii, for example, or places where people tend to actually really be more mixed race, and parts of the South as well, where Hispanics would oftentimes identify as 2 or more races. So yeah, I mean that's is definitely an important thing to consider, but we didn't dive into it too much.
Do we have in the interactive, August, do you recall, and other that's like other
We
and
do.
2 or more races combined?
It is in the interactive, just not in the report itself.
Yeah.
So if you're curious about any zip code, county, and want to see that share, it's definitely in there.
Great. So a kind of running theme in a few of the questions is related to kind of policy solutions or prescriptions, kind of based on some of the data and what it's showing us. So I think one here that I think encapsulates some of the other questions that have also been asked is, what were the key components of prosperous communities, and how, or what would be needed rather, to convert distressed communities to prosperous ones? How would you recommend it occur without displacement or other issues kind of like that? So Ken and August to take that.
Yeah, I'll start, and then August, you can let me know if you want to add afterwards. So it is, I mean, it is the question, and one of the motivating factors behind doing this research in the first place. So a couple initial thoughts is that, so one, actually, think we spent a lot of time talking about prosperous and distressed tiers here in the presentation, because I think the just dichotomies are often very stark. But if you look at where communities are I think where longstanding distress is blending into either through, I'd use the term gentrification, but just through changing urban demographics and urban markets, the zip codes often end up in the mid-tier category. So we also saw a big jump in the share of the country's urban population in that mid-tier category, as well as in the distressed category. And in a city like Baltimore or Philadelphia, we saw a number of zip codes move from mid-tier to distressed. They didn't make it all the way to comfortable or prosperous, but now they kind of land more in the middle of the distribution. And that's because they're bringing together mixes of people and mixes of backgrounds. And we know that mixed income neighborhoods are generally good. Of course, it's better if you're boosting individual incomes and opportunity directly, but the pernicious effects of chronic distress are themselves, an active inhibitor of achieving, really economic opportunity and progress in life. So I think it's important that really the neighborhood exposure conditions are moving, even if it's just a precondition to building that kind of more individual human-based inclusive economy that we hope for the next era of growth. But how do you make so what to do about prosperity, or how do you make distressed communities catch up, I guess, regardless? So a couple thoughts there without going on too long. So one, as I mentioned, educational attainment is the ticket to a high level of economic well-being in the United States today, and that lags significantly. That's also really hard policy space. It's hard to improve these things over, sometimes education policy works on generational cycles, really. So work needs to be done there for sure, but it's not quite enough. I think you also, though, just if you look at the map, you can see that even in areas of the Rust Belt, not to pick on Cleveland, you can look at even Columbus, though. That's a bright spot in the region. So much of its dynamism just never reaches chronically poor, often minority neighborhoods because it's sequestered in suburban jurisdictions outside of the central city, or just, since there's no limit on how far these places can sprawl, new investment just goes ever farther out and makes it harder for people who are stuck in chronically distressed areas to take advantage of it. So there you're really looking at the intra-regional geography of economic growth, where opportunities happening, where the public sector chooses to invest, and where the private sector chooses to invest. And by way of closing out, I think one interesting application that we're really pleased to see about the DCI is that some private companies, use it to identify suppliers or identify service providers or people they contract with, and to target reaching businesses in these communities, employing people from these communities. That's something that a large company can do with its purchasing power and with its leverage kind of over other companies it works with in a way that I think is beneficial for all involved. And that's one way that this insight, I think, or this material can inform micro decisions, right? By awareness of the divides helps people just think of new ways in their power to try to counteract them, and from the bottom up forge a more equitable geography.
Great.
August, did you want to add anything there? I droned on too long. I apologize.
Yeah, I think you covered it.
Okay, you can take the next one. Yeah.
Well, actually, Ken, I think that what you were saying about kind of more on the middle of the spectrum and focusing on some of those tiers that we talk about. There was a question also about the factors that contributed to communities switching from mid-tier to at-risk and vice versa. And can we say anything about comparing those two, and as well as within those two time periods as well?
Yeah, I can take that one. In the report, we actually profile a community in Michigan, Southfield, Michigan, which is a particularly interesting place because it is a majority Black middle class community that was prosperous in 2000 and is now at risk. And if you kind of look closely at the neighborhood, like a lot of what's driving this downward turn is basically a microcosm of what's happening in a lot of downwardly mobile places. A lot of like business closures, a loss of local jobs. It's also, its proximity to Detroit, which is sort of, kind of can drag down even like, more far-flung communities. And just, these are places that kind of have fallen through the cracks, so to speak, because they have historically been, well off, or at least comfortable, solidly middle class, like as the sort of bottom fell out of these communities during the Great Recession, for example. They've kind of just, not been the focus of a lot of policy efforts because, their progression, their downward progression has kind of just, maybe not been paid the attention it should have. So I think this is, again, something that, with the current recession is at risk of happening again. Places that maybe were, kind of straddling, boundaries between quintiles that now may be facing, more distress. And also places like Southfield are, going into this current crisis, are already kind of like, hard hit from the last crisis, and they have really, take this almost like decade of national growth to recover. So yeah, I'm not sure if that like exactly answers the question. Lisa doesn't necessarily answer the question going the other direction because there really aren't that many upwardly mobile places. I mean, there's a few, but most places tend to be pretty sticky, and if they do move one direction or the other, it's usually like downwardly. Yeah, so I'm not sure if Ken has something to kind of flesh that out a bit.
That was great. I think I'll just add that so we haven't run the numbers, but just knowing based on having looked at the DCI results for 5 years now, really one of the best predictors of where of a zip code that's going to fall into decline is whether it's adjacent to a distressed zip code already, because these things tend to creep, especially when there's no real outward bounds on how far metro areas are going to stretch and people are going to travel. kind of there's very little kind of bulwark as trying to slow the steady creep of decline or falling into distress. Of course, economic orientation plays as well, and as does initial segregation. And one theme that we don't go into in the report, but I would like to afterwards, or don't go into much, is to what extent might the segregation at the heart of many of the Midwest cities and metro areas actively be inhibiting kind of the region's renewal. I think it's a really important question, and yeah, one that we would be interested in exploring more. One other thing I'll add is that action in that mid-tier category that's also interesting. So that's the segment in which the kind of share of the country's Black population increased most. And it's also the section in which, if you think back to the median household income gap by race and ethnicity by quintile, it's the mid-tier section that experienced the biggest increase in, or the biggest, typical Black median household income fell most relative to the typical white median household income. It's still not as bad as it is in distressed zip codes, but it saw the biggest drop from where it was in that quintile prior. And I think that that's, in a way, kind of the unfinished business of the urban renaissance that we've seen over the past 2 decades, that a lot of the community conditions are improving, but it's not yet being reflected in the household conditions of, in this case, specifically Black Americans that are also living in these zip codes.
Great, thank you both. So a couple questions related to education and the educational attainment issue that August went through. So what is the predominant age group of those lacking a high school education and contributing to, and I'm not sure if this means living in distressed communities perhaps, but what is the age group where that's kind of the education level?
Yeah, that we haven't looked at beyond adults. I'd say my own intuition is that, so it's, I mean, in places with high elder poverty, that adults without a high school diploma is relatively high. So there, I think parts of the rural South, in some recent immigrant communities, that number or the educational attainment is pretty low. Some of that maybe they moved when they were young, or they don't have the credential that translated here. But that's one metric. Yeah, just a foreign background that is explains some of the variation there. But otherwise, it's a good question, and I don't know the answer beyond some of those 2 gut instincts.
Yeah, I would also add that we saw a pretty steep decrease in the share of adults without a high school diploma in distressed communities from 2000 to now. And I think it's safe to say that part of what's driving that is obviously, it's just becoming less common for adults to not have a high school diploma. And I think that's what's, driving that share down. So, which would suggest, I mean, we like Kenan said, we haven't looked at the data for this specifically, but would suggest that it is an older population that is lacking a high school diploma, and of course subgroups like new immigrants who might not have had that opportunity yet.
Yeah, but it's a real signal of kind of the deepest, most chronic distress if you go back to the literature on kind of urban environments that are most inhibiting of individual economic potential. It's areas where high school dropout rates are high and all, which is some of what that's capturing. But we look at share without a high school diploma specifically instead of some other cutoff of educational attainment, just because it is that minimum, very minimum kind of entry level ticket to generally decent jobs and living, is whether you have at least that high school diploma. So the lack of that is a big signal of economic distress. But it'll be interesting to watch this metric evolve over time and figure out whether a different benchmark or a different look at educational attainment is more attuned to how the country's evolving.
Great, thanks. A couple kind of, again, in a similar vein. The first, and they're related, so I'm going to kind of lump them together. How do we deal with educational attainment when we see the larger underemployment issue with college graduates? And maybe this next one is a little bit more separate, but I think still related. With automation and AI, are we going to continue to reduce jobs similar to what the Rust Belt saw in the 80s? And in what ways do we replace these jobs? So I think just generally kind of how do we deal with educational attainment when there is a general underemployment issue, particularly for people who have a bachelor's degree? And are we seeing that borne out in the data as well? And then a question kind of similarly related to automation, AI, how are we kind of thinking about replacing jobs or ensuring that higher skilled folks are still gainfully employed as well? So a little bit on the policy speculation side too, but maybe we can start.
August, I can go unless you want to, August.
You can start.
Okay. So educational attainment first. I think what we see in some of the graphics here is that I think credential inflation is real, and it's just ever more expensive and out of reach to obtain a bachelor's degree. And then once you do, there's an open question whether or not you actually need it. So I think it's interesting, and problematic just to see. So sorry, where was I going with that? It's a good question, but I think that to some extent, the job and occupational mix answers some of this. You can get an associate's degree. That's the group that's generally most evenly distributed across zip codes, and also they have pretty equal access to prosperous areas versus distressed ones. Just the more, I think that the more credentials that you have, the more opportunities are opened up, and then therefore just the higher likelihood that you're able to get out of a distressed community if you want to. So I definitely don't think that the DCI says that everyone needs a bachelor's degree and then the whole map is going to be our prosperous shade of blue here. That's not going to be the case, but just progressively more, it's just associated. The more you get, the better off you are generally. So how do we just bump more people up higher on the spectrum is an open question. But then also, how do you do it quickly, efficiently, and at low cost? That's the real policy question. So a bit of a non-answer there. Moving on to the Rust Belt. One thing that EIG tracks in its other work around entrepreneurship and underlying economic dynamism that I think is relevant here and to the question of automation and AI is that the Rust Belt and Great Lakes and older parts of the country in general stand out for having often really exceptionally low startup rates, and that means that they are more attached to the status quo economy as it exists today than other parts of the region that have more turnover and churn in types of businesses and employers, in occupations, and what people are doing. That churn just makes places adaptable and the people in them, more adaptable too and able to find better opportunity. Whereas if you're in, some metro areas in the Midwest, even some large ones and especially some small ones, where your fate's really hitched to how many people a particular plant employs, you are absolutely at risk of the whims of automation and globalization and trade and all wherever that's headed post-pandemic. So the point there is rekindling an entrepreneurship and dynamism agenda. So these places can figure out what's coming next. They can't slow the inevitable or try to fight it, but they can make sure that other stuff is percolating in their economy to employ displaced workers and to kind of figure out what their future reason, economic reason for being is, if the past one looks like it's not going to last that long, is really important. And that's kind of part of a macro national economic adjustment agenda that EIG is really excited to be thinking about and working with some others on.
Great, thanks. There are a couple more questions about specifically about the report, but given that it's kind of closer to the top of the hour and folks may need to hop off, I wanted to make sure that we also talk about ways that folks can use the DCI or work with us further on this, and also maybe preview some of the kind of additional work using the DCI and the data that we have that we're planning on releasing in the next couple of months. So maybe we'll do that and then go back to a couple of final questions.
Yeah, sounds great. So ways you can use the DCI, it's, well, first just go explore the interactive. We've automated the data licensing process. So you can find get the data tab there on the website. Let us know if you need any help with that. I think we've seen it used recently in a couple of interesting ways. So by academics, especially in the health research area, the DCI's demonstrated a pretty powerful ability to kind of serve as a independent variable controlling for the socioeconomic status and kind of the social determinants of health, and entering that into studies of health outcomes or surgery outcomes or Medicare, reimbursement rates and things like that. And we've also seen it lined up with more political analyses as well. I think that's going to be germane, of course, coming in the season here. And then, we've seen some state and local governments as well as nonprofits use the DCI for a screen, for eligibility for certain grant programs or for targeting their outreach, or similarly to the supplier conversation I was talking about before, private companies doing the same. And then it provides really fine-grained local intelligence that can be useful in the finance industry, can be useful in, I think all sorts of ways. So we'd love to hear from you how you'd like to use the DCI. And then going to what's coming soon. So keep your eye out. Hopefully over the next 2 weeks, we'll be releasing 3 derivative products. So one applies the DCI methodology to rank and compare cities themselves. And just how those places rank against each other, and what that tells us about the country and about how we live down to kind of the jurisdictions and local governments that we call home. We'll be looking at swing states, and in particular some swing counties and swing states, and how they've fared over the course of the young century that we've charted here in the report. So going deep into that. And then we're also going to be lining the DCI up with COVID-19 case rates, mortality rates, and exploring kind of to what extent this data tells us, what does it tell us about the map of the pandemic's impacts. So, and more to come from there. We'd love to hear your ideas too. And we're definitely open to supplying the data to help your work, to informing things, to presenting, and to possible partnerships to explore ways to see what insights can be unlocked here with the DCI as a starting point.
Great. So a couple more questions. I think we have a few more minutes. So the first is, does the adults not working population, that metric that we use, include those in prison within that zip code?
Yeah, I can cover that. We actually no, for the most part, because we actually don't include zip codes in most zip codes in the analysis that are institutionalized populations. We also don't include most military-based zip codes or most college campus zip codes. So for the most part, at least institutionalized prison populations are not being considered in this index.
Great, thanks, August. Next question is, can you share any examples of prosperous racially mixed communities?
Yeah, we can, and I feel like we were just talking about this. I'm blanking on some of them. August, do you have any at the ready? Or...
well, this actually kind of fits with another question someone brought up, which is this data available at the census tract level, and I think it's important to note that this is zip code level data, which a lot of the more prosperous mixed race communities you tend to see are in major cities, which sometimes those spill over into multiple zip codes. So it's a little bit difficult to capture with zip code level data. Example that I came across, for example, is Hyde Park, which is a generally like in Chicago, which is generally considered a successful mixed race neighborhood. But it's it kind of like the zip code that covers Hyde Park also straddles a low income majority Black zip code, so the numbers get a little jumbled. But if you also look at the Chicago region, Flossmoor, which is a suburb south of Chicago, does tend to be mixed race, and it does fit pretty neatly into a zip code. So there are like a few of those out there, but they're just not that many at the zip code level.
Yeah, and where they do exist, they do tend to be at the heart of or around part of real major metro areas. So I think that some of these zip codes in, especially Prince George's County in Maryland and DC, those are, I guess, not diverse in the sense that they're mixed, but they're have really high levels of Black prosperity. And then, yeah, there are a few from there that do, yeah, have some, but generally, I'd say each major metro area has no more than a handful of really mixed places that rank at the top of well-being. I think one thing that we document here, and we haven't zoomed in on any particular zip codes, but like just go to Cleveland, go to Detroit, look at the outlines of the red zone. Chances are those are exactly coterminous with the boundaries of the city, which are also coterminous with the local kind of boundaries of segregation in these cities. So often, often you don't end up with very mixed areas.
The follow-up question, I think, on I believe the point that Ken was making about some of our work on entrepreneurship and increasing numbers of new businesses and economic dynamism. There's a question asking to expand a bit on the impact of startups. This is on the DCI, but maybe kind of more broadly on communities and where they rank in the DCI. Can they impact the numbers and where they fall in terms of the tiers and how?
Yeah, good question. So I'd say yes, sometimes, and there I really do go look to the West, where you have pretty high numbers of startup rates, and Denver has very few distressed zip codes left, even though it's one of the country's largest metropolitan areas. Same with Salt Lake City in the Utah area, and startups, they seem to they just help make keep a place vibrant and kind of ever renewing. And I think they're also what even don't have data behind it, but just kind of a sense that they are kind of more likely to be reflective of the more diverse millennial generation, maybe hiring more from that pool and kind of leading the vanguard of the country's demographic change and bring that current, to with the economy and with the business landscape. Whereas if you're in more staid parts of the country, I don't think you get that as much. One thing that is important to note, and it's kind of a subpoint that was there in August slide on the distribution of the Black population by region, the West. The West is one of the most diverse parts of the country for sure, but that diversity is led primarily by Hispanic and Asian populations and not the Black population. And those places are generally quite new, and they've been growing rapidly for a while now, but they don't have the legacy of segregation, deindustrialization, kind of the kind of tumultuous period in the country's racial history that marked itself really deeply in the cities of the East. And we talk about legacy cities in other EIG work, and that legacy of racial inequality is still at the heart of the eastern half of the map, and but it left much of the West, relatively unencumbered. And again, to what extent might that kind of blank slate in the West have allowed them to grow kind of more dynamically, more inclusively, more startups and all, and just had what looked like healthier economies because they didn't start with this kind of element at their center.
This actually might be an interesting point to kind of expand on with this next question. Is it safe to say that the South is the most distressed region in the country? Any further comments or thoughts on why that region is struggling? So perhaps an expansion of the point you just made, or if you want to add on to that.
Yeah, I'll get started, but try not to take too long, so let August speak to it as well. So the South is, the South has the highest concentration of distressed zip codes. It is the country's most distressed region. A lot of that, though, is rooted in the rural South, which is kind of the least economically developed part of the country. But one thing that was really interesting to us was that, again, back to August regional slide, the Black population is more likely to live in a distressed zip code in the Midwest than it is in the South and Southeast. So I think that as we, especially, of the crises that 2020 has brought to the fore, the crisis around, racial inequality and all that's played out in Louisville, Minneapolis, Cincinnati, back earlier in the decade. St. Louis and Ferguson and all that is a product of the Midwest right now. It's not, cities like Memphis are extremely segregated as well, but the nature of it's different in the Midwest versus the South, and it's tied up in kind of the industrial and urban history of the region. But August, I'm sure you have other things to add.
Yeah, you kind of touched on what I was going to say, is that if you look at urban areas, the Midwest is, and parts of the Northeast, I mean, basically that belt of legacy cities that tend to be highly segregated by race, and dealing with a lot of baggage of legacy industries that are definitely like the most distressed. But looking outside the boundaries of cities in the Midwest and other parts of the country, like rural and suburban areas of the Midwest, are doing quite well. So it's just geographically different in the South versus the Midwest. I mean, I definitely think, especially for people of color, there's for Blacks and Hispanics, there's definitely more economic opportunity in the cities of the South than there are in the Midwest, where there's just a lot of barriers to upward mobility.
Yeah, and part of the really low incomes for Black Americans in that median household income chart that August came from is likely attributable to the very rural Deep South, which is just the lowest income, highest poverty corner of the country. Incomes there are not going to be any much lower than in Gary, Indiana, one of the other most distressed corners. But I think that's often that's part of the country lags just so far behind that it's definitely a piece of the story here. Yeah. And then there's an interesting point in the report where we just quickly compare Nashville to Memphis, both of which have very different kind of economic structures, startup scenes, and racial histories and segregation mixes and all. And it's really telling to see how well Nashville has done on so many fronts over the period that we look at here, against comparatively little progress in Memphis.
Great, thanks. One more kind of more methodological question again, related to the use of university communities or not, rather, kind of the leaving out of some of those of those zip codes. Can you clarify a little bit more about not using university communities in the index? And I guess the reasoning behind that. The context here is in the Northeast, a number of colleges are surrounded by more impoverished minority communities. Does that skew, or were the populations not large enough to impact the overall numbers?
Oh yeah, I could feel that question. So we excluded zip codes where there was a unusually high share of students living in those communities. So that depending on the boundaries of the zip code, that wouldn't impact a lot of minority communities close to college campuses, because those are generally not communities where college students are living. They're usually living either on campus, or they tend to live in more, I guess you'd call it, segregated communities with other students. So we still have captured a lot of those more impoverished minority communities that are kind of adjacent to campuses, but in their own zip code and kind of have their own distinct demographics.
Great. All right, I think we've covered just about every question. If we did miss anything, we will be sure to review Q&A and chats and reach out if there's anything that we did miss, or feel free to reach out to us as well. Again, I want to thank my colleagues, Kenan, August, and John for joining us and for presenting what we hope is a really useful and impactful tool to your work. We really appreciate all the comments as well. It sounds like this is already being put to great use, and we're really, really happy about that, and would love to continue to work with you. Like Kenan said, we'll be coming out with a bit more in terms of additional analysis, as well as there's ways to use the DCI data and license that from us as well. So if you have any questions or need additional information on any of those ways to connect with us further, please go to our website. You should be able to find out how to contact us best. A reminder too that and the best contact is info@eig.org. That will get immediately funneled to the right person to ensure that we can get to your inquiry and answer it promptly. One reminder that we are recording this, or we did record this presentation, and we will be circulating that recording to everybody who attended and registered after this webinar. Kenan, August, any closing thoughts?
Just some of the comments were really nice. Thank you. I hadn't seen them until now when I stopped sharing them. Yeah, so thanks. And yeah, please do share, tweet, put us on LinkedIn, help us spread the word. And yeah, thanks so much.
Great. Thanks, everybody. Have a great rest of your day, and thanks again for joining.